Hi, everyone. I'm Mike Evers, and I'm OrthoWorld's digital content strategist. And in that role, I handle a lot of the revenue modeling and reporting for OrthoWorld. So today, I wanted to share some of my takeaways as we approach the end of 2020. We'll start by recapping some of the most important trends in orthopedics for 2020, and then we'll take a look at how the market is recovering from the pandemic. And then finally, I'll share my 2020 projections for the full year. So let's get started by recapping our most important trends for the year. In my last webinar, we talked about the strong underlying fundamentals of the market, including three trends in particular. Number one, enabling technology. Number two, mergers and acquisitions. And number three, the ongoing shift of procedures to the ASC setting. And what we've really seen in the last 12 to 18 months is the ability of enabling technology to drive revenue and convert competitive accounts. Now, of course, the big influx of revenue from a capital sale, like $1 million for a robot, for instance, is nice, but that is increasingly rare in the COVID era. And it's also really just the tip of the iceberg in terms of the opportunity presented by enabling technology. We've seen also that you have a better sales mix in accounts with one of your robots. That is to say that you are more able to sell your premium products at a premium price. You've also have the ability to sell more products per procedure when enabling technology is present. A lot of companies call this pull-through sales. Others call it caravan sales. It's essentially the same thing. And then Brian Hansen over at Zimmer Biomet often talks about how you can't forget the annuities that come with enabling technology, for instance, disposables and service contracts. Overall, right now, market penetration is low for robotics. In the US, it's about 10% for surgeries in the US, according to Johnson& Johnson's medical device update recently. If we look globally, that number shrinks to about 1%. So a lot of runway for really rapid growth here in this segment. We also estimate that adoption will increase rapidly as well. In the next 10 years, Johnson & Johnson believes that up to 30% of all joint replacement surgeries will employ robotics of some kind. There are other companies out there even more bullish. Globus Medical, for instance, is really confident about the rapid adoption of robotics in orthopedics. When COVID first started hitting the industry, there was a sense that enabling technology capital purchases were just going to sit the year out, essentially, that hospitals had neither the appetite nor budget to evaluate or purchase these technologies. But what we've really seen is that if you can have a differentiated technology and you can convince a hospital that they'll benefit from it, you're still able to have those conversations in the market. And Jeffrey Martha from Medtronic made a really great point recently when he said that in orthopedics, at least, robotics tend to be in highly profitable procedures for hospitals in spine and joint replacement. So hospitals are incentivized to bring on board these technologies as a part of their own recoveries. If we look at just the raw number of deals in terms of mergers and acquisitions for 2020, I suspect it'll be less than last year. However, I remain surprised by the really brisk pace of tuck-in acquisitions, considering the COVID environment and how companies were really doing everything they could to conserve cash at the beginning there. A lot of these are downstream consequences of the Stryker and Wright Medical deal. For instance, Star Ankle going over to DJO as part of the regulatory process. I also saw Smith and Nephew's acquisition of Integra's Orthopedics as a bit of a counter move to DJO's acquisition. And then if we expand our view out even further downstream, you could say that Medartis acquiring a stake in Kerry Medical to bolster their extremity joint replacement business really is just an indicator that many companies believe that there are segments or subsegments at play that you can take share in this environment if you're willing to be bold and aggressive. And a couple other examples of those types of moves is Medtronic's acquisition of Medicrea to bolster Mazor as they continue to try to fend off increased competition in spinal robotics from Globus and NuVasive. Zimmer Biomet is another example with their acquisition of Incisive and Reline uh, to really bolster their ASC sports medicine business. And then Colfax, the parent company of DJO, has said that they intend to remain active in tuck-in acquisitions in joint replacement as they see it as a really quick way to fold in some inorganic growth in that segment. And then finally, let's take a look at the ongoing shift of procedures to ASCs. And as I said, it's ongoing. It's been going on for several years, but in a slow burn capacity. And I think there was a sense early in the pandemic that COVID would be a transformative event that caused ASCs to reach critical mass and realize a period of explosive growth. But I think anyone who was paying attention realized that that wasn't going to be feasible strictly because of the lack of capacity in ASCs. There are not enough ASCs currently to accommodate that amount of growth. If we look right now, um, ASC penetration for spine and large joint is in the mid single to high single digits, even among companies that really focus on ASCs, like a Smith and Nephew, for instance. And we did see some procedures move to the ASC during COVID, but I suspect much of those gains are transient. And that in a post-vaccine, post-COVID environment, many of those will move back to the hospital setting. But it is clear also that the largest players in orthopedics are becoming increasingly focused on ASCs. For example, you have Smith and Nephew and DePuy Synthes producing, I would call them ASC optimized robotics. You have, as we mentioned before, Zimmer Biomet investing heavily in their sports medicine segment. And then Stryker and Acumed are just two examples of this fairly recent profusion of all-in-one ASC plans, where the device company provides the design, the inventory, the pricing, the billing, and the financing, all in an effort to very quickly stand up an ASC. So clearly, COVID has impacted the orthopedic market in every aspect, but we believe these trends, enabling technology, mergers and acquisitions, and the ongoing shift of procedures to ASCs, they're going to increasingly drive strategic decision making as companies attempt to emerge from the pandemic in the strongest possible position. Now we'll take a look at how COVID impacted the industry over the course of the year, as well as how it recovered in the second half here. And I think the market recovered more quickly than most of us anticipated. But I think that last bit, that last leg of the recovery is going to take us well into 2021. And as we go on to the next slide, it's not hard to see why. With these graphs from the COVID tracking project, um, it's really difficult to find any good news in these trends here. And I think a common refrain that you can hear in the third quarter earnings calls is if there's another surge. But looking at this data, it's not a question of if, and it hasn't been in quite some time. Maybe we can reframe that statement as if there's another shutdown. And I find that highly unlikely that we'll have another mandatory national shutdown for elective procedures. And I think that's a consensus among device company executives and analysts. But still, and while we don't know what a new administration in January in the US will bring, it's clear that these type of trends and these types of numbers are going to harm patient confidence, and that's going to play a role into 2021 for sure. And then if we look internationally, where restrictions are in place in places like Europe, they're already negatively impacting fourth quarter results. For example, Amplitude Surgical in France, for the period of late October and early November, they were down 30%. So it'll be interesting to see as the fourth quarter closes just how much of an impact that's going to have. So what I did here is I took a selection of the top players, about 61% of the market by revenue, and I'm using them as a proxy for the overall market. And I plotted their year-over-year growth by quarter. And you can very easily see the course of the pandemic in orthopedics over 2020, where we start to feel those impacts in late Q1, and then we bottom out in Q2. In late Q2, early Q3 is really where we see that procedure backlog kicking in to create the sharp V recovery. But as we get into Q3, that backlog depletes and we flatten out. Currently, we believe that the market is operating at about 90% of its historical volume. And although we do believe that Q4 will be a sequential improvement, it won't be to the extent that it really lets us completely close the gap on the losses for the year. And it's even more apparent if we plot the sequential improvement quarter over quarter during the year. So here we're looking at those same companies, but in this case, we're comparing Q2 to Q1, Q3 to Q2, and so on. And you can very clearly see the extreme attack and decay of the recovery as it peaks in Q3 and then quickly falls off. And I think it's also important to note that the recovery is not a homogeneous thing. It is highly fragmented and variable by region, by product, by company. And then as we drill down even further and look at individual companies, we see a handful of them that really outperform the market and their peers, which to us says that they're taking share. So here's a quote from Dave Dembski over at Globus, where he talks a little bit about how we're continuing to see small shutdowns, but they're geographically isolated and they resolve far more quickly than they did early in the pandemic. But the real key takeaway here is that at some point in November, Globus had their best week of US sales in company history. Some other players that we believe are taking share in Q3, ATEC with just an absurd 41% growth for the quarter. DJO, their joint replacement business, was up 9.3%. Globus here up 10% for the third quarter, and then C-Spine up 8.3% in the third quarter. Now, finally, let's turn our attention to our projections for full year 2020. And clearly, this is an unprecedented year in orthopedics with a profound amount of uncertainty still remaining. But we think there's enough information available that we can make some educated guesses as to how the year is going to end up. As I said previously, the following revenue is about 61% of the total market, and it includes all the top tier players with a good cross-section of mid-tier players as well. However, to reduce uncertainty, we only considered public companies for this. So for full year 2020, we believe the market is going to decline about 10%. And that's really driven by the low point of the market in April and May, followed by a steep recovery that quickly petered out as the surgical backlog depleted. So overall, the clock will run out in 2020 in terms of regaining these last bit of losses here. However, still a far better result than I think most of us expected, certainly as we looked at the data coming out of the early pandemic. What is interesting, however, is even though things in orthopedics seem to change almost hourly in the early courses of the pandemic, uh, the relative resilience or exposure of certain segments stayed constant, where you can see trauma and hips demonstrated significant resilience across the year, while knees and sports medicine uh, continued to struggle throughout the year. Now we narrow our focus even further to just a subset of companies, the top players. And I think you probably see what you would expect here, right? Where the market is down about 10% and Stryker does a little bit better than that. And then some of the companies that were in the midst of their own turnarounds as the pandemic hit struggled a little bit more compared to the market average. So here are three quick takeaways for our projections for 2020. Number one, the recovery is asymmetrical. As I said, it's very difficult to make any kind of blanket or broad statement about the recovery because it is so variable based on region, product, and company. The recovery was not a tide that lifted all boats equally. There are some players who took this market disruption and made it an opportunity for themselves, and we believe are gaining share and are in a position to continue to gain share in the next several quarters. And finally, as volumes approach historical norms, um, we expect at some point in 2021, growth rates are going to be comparable to what they were in 2019. As I said, there will be some lingering impacts in the first half for sure, but I suspect on the whole, 2021 and 2019 will be fairly comparable. So let's wrap it up with a couple overall takeaways. Number one, the market is going to be down about 10% this year, we believe. We believe that the surgical volumes in the industry have stabilized, and that is to say, we don't anticipate any major shutdowns, nor do we anticipate any major infusions of backlog procedures. We're kind of playing the hand we have at this point. And finally, COVID will remain a factor in orthopedics for a long time, certainly into next year in terms of patient confidence and infection rates and things like that, but also some of the operational changes companies made during the pandemic, I believe will be around long term as well. And before you go, I just wanted to invite you to head over to orthoworld.com in our downloads section, where I've published the data set that I used for all of these slides. It features summaries for segments and companies, as well as a detailed tab for each company. So if you'd like to dive a little bit deeper into the numbers or do some of your own analysis, you can head over to orthoworld.com in the downloads section. So thank you so much for watching. From all of us at OrthoWorld, we wish you prosperity and good health in the coming year. Thanks.